quite a hectic start to the week, and we'd like to take the opportunity to share a bit with you what we think what caused this volatility and what we made out of it and how we position our portfolios going forward. To begin with, 2018 saw a very, very strong start. Equities were chasing one record after the other, not only in the US but also in Europe and in Asia. And what it showed that basically by mid-end of January, some of the valuation indicators signaled a bit of an overheating. On top of that, we still had very strong macro numbers, but the scrutiny was more and more focusing on the inflation impact these macro numbers have. And of course, the market was a bit afraid that rapidly rising inflation will cause a rapid repricing of the bond market, which could then have impacts on equity valuations. Everything was rounded up with some nervousness around the political situation in Germany. Will we have a coalition? What does it mean for Europe's ability to reform? And questions around the tax policy of Trump and what it means for the overall economy in the United States. For us, all of that was reason enough to start de-risking our portfolios mid-end of January. So we started to reduce our equity exposure, we sold some of the very expensive bonds, and we built in some hedging strategies to prepare for a potential correction without totally leaving the market. So we were still invested, but with a much lower risk profile. The correction that we saw on Monday eventually was triggered not by some inflation numbers or Mr. Trump, it was triggered from the options market. You may have heard that there were a lot of strategies out there that were betting on low volatility forever. Now, as volatility started to increase last week, more and more of these strategies had to de-risk their portfolios, and once that started, it triggered a spiral with the consequences that we saw on Monday. That means that the correction was pretty much technical and not driven by a change in the fundamental picture. So that for us it was obvious that the economic cycle, employment, consumption, investment is still very solid, and we do not change our view on those parameters at all. Which means we still have a very healthy environment for corporate profits, we still have a very healthy environment to take risks in the equity and the bond market, and we used the opportunity of more attractive valuations to rebuild our positions in the three portfolios that we manage. So we added equity exposure, we added corporate bond exposure, we reduced the insurance policies in the portfolios, in the defensive, in the active, and in the dynamic. And we would probably see a bit more days where you have some shaky moments in the market, nothing compared to what we saw on Monday, but definitely more opportunities for us to rebuild our position, and we're going to use them actively to continue to achieve good returns for our investors.